you everybody for joining today. And I would like to welcome today Brian Bell and Nigel D'Souza, two very esteemed speakers on our panel. Nigel is a Star Mind top-ranked analyst covering Canadian bank, and he currently leads financial services at Veritas Investment Research. He has tons of experience in the Bay Street across investment management and also always brings unique data-driven perspectives. I have admired and followed his research for a while now. Needless to say, he has a CFA and of course graduated with high distinction from the University of Toronto. So welcome, Nigel, to our webinar.
Thanks for having me on. Appreciate it.
Thank you. And we also have Brian Bell. Brian is the president of Giraffe Realty. It's a new and innovative real estate company that actually leverages big data and AI to help drive better insights. They are building several data-driven tools for the real estate industry, which people like myself will be consumers of, such as Real Estate Investment Index. They're also setting up an innovation lab. Brian, of course, comes with tons of industry experience. So everything that we are going to cover today, he's probably been on the inside of it. He has worked at CMHC, Canada Guarantee, two of the biggest reinsurers. He used to work at Brookfield Residential as VP Sales and FNF or Fidelity Canada. So he covers insurance, reinsurance, and real estate, all aspects of this industry. And that's what we are going to dive into today. So as you all know, I think the topic for our discussion today is driven by CMHC, but it's kind of more what the question is in all of our minds. So right now, yes, economy is a question mark. The virus-driven COVID-19 count is a question mark. The recovery is a question mark. Meanwhile, there are some forecasts. Everybody is trying to make predictions, and one such was done by CMHC. In the first report they came out with, that was 2 months ago in May, correct me if I'm wrong, they had indicated that literally everything is going to dispel doomsday, so to say, because they said everything's going to go down, house prices down by 18% over the next year, mortgage deferrals would jump by 20% by September, mortgage arrears could top 20%, and the debt to GDP will rise from 99 pre-COVID to 130 by Q3. That said, of course, people tried to check them and said, hey, this is a little too dark. And then they revised their forecast. So on that note, I will start with our first question to our panelists. And Nigel, maybe we'll start with you. As you know very well, that CMHC is, in its last status report, still predicted that home prices in some of the major urban centers could decline by as much as 12% over the next 18 months. And recovery was around 2022. Everyone thinks this is panic-inducing. What are your thoughts on these estimates?
Thanks for the question. So I think the first important thing to keep in mind is that CMHC's forecast is an estimate for the decline in real estate prices from peak to trough, right? So they're not necessarily saying that's the decline you should expect on a year-over-year basis. On a year-over-year basis, the decline is more so in the lines of single-digit decline, and that forecast isn't out of consensus, let's say. A lot of bank economists, a lot of other forecasters are predicting mid-single digit to maybe high single-digit decline year-over-year in real estate prices that's expected to bottom sometime in the middle of 2021. So given the current rate of unemployment, we have unemployment that's above 12% in Canada, and we have a very weak economic backdrop. So in that type of environment, I don't think a single-digit decline in real estate price is unreasonable. I think that's a fairly reasonable estimate. Now, with that said, I can understand why some participants in the industry would label it panic-inducing. But so far, from what we've seen through in 2020 in the real estate market, it hasn't really had done anything to dampen the exuberance for Canadian real estate. Canadian real estate seems to be doing still fairly well, despite a ongoing pandemic and despite relatively adverse market conditions. So while at the moment in time when we had a lot of uncertainty driven by the coronavirus, driven by government shutdowns, and just volatility, that may have been seen as panic-inducing. On the whole, if you step back and you take a look at what they're actually saying on a year-over-year basis, and you look at the economic context, I don't think it's too unreasonable, and I don't think it's something that we would categorize as way out in left field.
That's fair. Brian, what do you think?
Yeah, Nigel hit the nail right on the head when you really look at it. And so my first job was actually at CMHC as a housing market analyst. So it's really complicated when you're church, state, and you're trying to be Switzerland within doing housing forecasts. And I talked to their economists around it, and I think even internally they were having lots of dissension amongst each other around how are we going to forecast this. And Nigel talked about peak to trough, and that sort of got missed when that actually got put out into the marketplace. So it created panic, and I don't actually think they were intending on doing that. I think anytime you're sitting with unprecedented situation that we're in, you would have declined a down market, and I would have actually done the exact same if I was still at CMHC in that role. I expected to see that. So and I think Nigel's spot on. It is going to be a single-digit decline, but it really depends on which market we're looking at. If you're in Alberta and oil is impacted heavily, you may see double digits into that market. Vancouver may be single, and Toronto, what I'm watching when looking at the data in the last couple of months, we're bucking the trend around it. So, what causes house price depreciation is job loss. Well, we're at record number of job losses, and we're not seeing average price going down. So we're in a little bit of a bubble right now, and I think it's very hard to predict. And I think I would agree with Nigel. We will see, a decline, but you're going to see decline by house price point. I think your average house price is not going to see that much. So your demand for the first-time buyer market, your townhouses, and your various price points that are there, the high end and various markets may see differentials. So it's a tale of many differing stories, whether it's by property type and by actually geography.
Yeah, talking about property types and first-time home buyers, even the StatScan report says that people adversely affected by the current COVID scenario or job losses have primarily been on the younger side, often millennials and often new immigrants to Canada. I mean, a lot of the housing prices have been driven by this population, the new immigrant population in Canada, which is creating the whole demand supply gap. Now that's changing. A, fewer people coming in, and B, people losing jobs at that end. Does that mean that that we will see some drop in prices there? Because on CMHC's side, starting 1st July for insured mortgages, they're effectively reducing home buyers' purchasing powers. Right? And if they're going to have stricter guidelines on that, it basically means these people who are already negatively impacted with job losses and or furloughs or cuts are going to be impacted even further. What do you think of that, Nigel?
Sure. Yeah, I'll start on that. So I think first, in respect to the rule changes, again, we have to keep in mind how many individuals can potentially be impacted by the rule change, right? So as part of the new rule changes from CMHC, the gross debt service ratio is for qualification is now reduced to 35%. It was 39%. Now, according to CMHC, that rule change would only apply to less than 10% of mortgage insurance applicants, right? So, with the updated rule change, only a small portion of the existing insured mortgage applicants would not qualify. And you also have to keep in mind that insured mortgages have lost market share over the last decade. The CMHC and the government have been pushing on tighter qualification requirements for quite a number of years. And you also have to keep in mind that CMHC insurance does not apply and is not available for properties over $1 million in value. So that takes out a big part of the market. So detached units in major real estate markets like Toronto or Vancouver would not be driven by CMHC insured mortgages. It would be more, the insurance aspect of the mortgage market would play more for condos or in real estate markets outside of Toronto and Vancouver. So overall, these rule changes, in my view, should not have a significant impact on the mortgage market or on the real estate market. And you also have to keep in mind that CMHC peers, the private insurers like Genworth and Canada Guarantee, have announced that they're not going to follow the rule changes implemented by CMHC. So they could pick up market share in this environment. What CMHC is essentially doing is reducing the risk exposure to the government and to Canadian taxpayers. But with that said, even with these changes, we have to remember that we have a backdrop of a low interest rate environment, right? Mortgage rates are not heading higher anytime soon. And the strength that we're seeing in real estate right now doesn't seem to indicate that mortgage credit is being restricted in any material or significant way. So overall, I think CMHC is actually being prudent. I think we have to keep in mind that Canadian households are highly indebted. Debt to income ratios are high, debt servicing costs are high. And the main, I think, aim of these macroprudential policies is to limit and control the increase in household debt. Now, unfortunately, household debt continues to go higher, and the CMHC itself, as part of its forecast, expects household debt to income to surpass 200% as we exit this crisis. So household debt is expected to continue to be an issue, and at some point, these households have to delever. Hasn't happened yet, but I think the rule changes that we're seeing are mainly aimed at trying to limit leverage and potentially soften the deleveraging process that has to eventually happen.
Yep, fair enough. I mean, on the deleverage piece, I feel like the Canadian folks are already pretty much levered to the hilt. Like, debt to disposable income ratio was already around 176%. Of course, real estate adds to the problems, doesn't help, but it was already over leveraged, worse than US folks were in 2008 actually. And as per current forecast, that's going to get even worse. It's supposed to go up to almost to 30% by next year actually. I don't know what that means really for the economy, or is it just the bubble expanding even more and more if CMHC guidelines, for example, are not in true spirit trying to restrict leverage as much? Brian, what do you think of this?
It's a great question, and CMHC is wanting to reduce their exposure. If you actually even looked at the financial reportings of CMHC and Genworth, you actually see that mortgage default insurance is the most profitable insurance line in Canada, and has been for a perpetual basis. So it's not out of losses because of default or there. I really think it is debt that was really driving CMHC to make the policy change. That's where they're really worried about is taking on too much debt. Anytime you make policy changes like this, what happens is the market doesn't have any impact, to be honest. And I've seen it because I've sat in the role as a mortgage default insurers. What happens is your secondary, your B market, your C market, you're just shifting what the consumer is actually paying now. So your A customer that would have had that preferred rate now is going to be paying an extra 2 points with a private lender or a B lender, or and we talk about the B lending market. The B lending market looks like what the A market was 5 years ago. So if you're a B lender, you're probably the happiest you've ever seen your portfolio look than ever. And the mortgage investment companies, or the private lenders, have exploded in the last 3 years as a result of policy change. So people are still going to buy this house regardless of whether the government does it. It's going to cost them more money, and it actually probably puts them at a disadvantage by making massive policy change around it. So.
Yeah, and both of you touched on the debt or the mortgage issues, but then mortgage deferrals that the government has allowed for is going to come to an end eventually, right? This fall, you will see some of that go away. But does that mean that we will see a lot of defaults? And maybe, Brian, you could comment on that. Are you seeing defaults in the market already starting out? Or is this post-CERB benefits that we will actually see any defaults? Is it more in Toronto versus outside, where Toronto is extremely expensive? What do you see some of the trends there in the market?
Yeah, default's a really good question. So the right way to answer the question is that we're in a bubble right now. So the government has had emergency funding for people. You've had 20% of mortgages are in deferral. So the deferrals come to an end at the end of September. And then if you stop paying your mortgage, the lenders tend to take action after 90 days. So the truth to the answer of the question is we don't know until December, January, February of next year how much default is going to take place. Nigel, being an analyst, would know how much they put in loan loss reserves. We have seen record number of loans, so the banks are expecting a high number to happen. So, you know, I think the decline in actual house price will come with this bubble of defaults hitting the marketplace. Just touching on credit score, on that 680 change. The 680 changes doesn't impact the GTA and the major urban centers because their average credit scores were 680. Once again, mortgage default insurance is causing an issue for outside of these major urban areas. So when you look in the East Coast, your average credit score is 630, and you look in Northern Ontario, 6. So more of the rural markets, you're going to see the fundamental policy changes have a bigger impact than in the major urban centers.
Nigel, would you like to add to that? The whole default and the deferral issue that I feel like is coming at us. Is just a matter of time. And if CERB is extended by a few more weeks at a time, maybe you can push it to Christmas, but then come Christmas, Santa is not going to be happy.
Yeah, no, it's a good point about deferrals. You know, to keep in mind, the level of deferrals we're seeing in Canada is quite high. So the amount of mortgage deferrals the Canadian market's experiencing right now is about twice the level of what the U.S. mortgage market is experiencing in deferrals through the pandemic. Now, the $1 trillion question is how many of those deferrals actually become delinquent. That we don't know. I don't even think the banks themselves know at the moment. They might form an estimate, and then they're being very conservative on the mortgage side of the business. So if you look at the financials of the banks, you'll notice that they're building a lot of provisions, but it's more so for credit cards, commercial lending, unsecured lines of credit, not so much so for mortgages. So the banks themselves at the moment probably aren't too sure on the amount of deferred loans that are eventually going to migrate into delinquent. And you have to keep in mind, like if you look at delinquency rates for mortgages in Canada, during the financial crisis, they topped out at less than 0.5%. And I think if you go back to 1970, they've never been higher than 1% in terms of the mortgage delinquency rate. And the amount of mortgage we have in deferral today are between 15 and 20%. It varies, you know, based on financial institution, but it's around there. And B lenders actually tend to have a higher amount of deferred mortgages on their book. But based on that number for around, let's say 20%, you know, even if 1 in 10 mortgages eventually migrate to delinquent, you're looking at about a 2% delinquency rate. That's going to be, you know, twice as high as the highest we've ever seen in Canada. So how does that actually impact the market, the mortgage market, the lending market, the real estate market? We don't know. And the challenge here is also that these delinquencies, it's a cliff. It's not a gradual delinquency slope. It's a delinquency and deferral cliff. So all of these the delinquency clock starts at the same time for everyone. And the issue for real estate is that ultimately, real estate is not like the stock market. It's not a highly liquid market. You don't have a high number of stock transacting on a daily basis. So what's required for prices to go down is a supply shock. So, you know, there are multiple factors here, but the deferral cliff could be a source of a supply shock if you have a wave of people that are either approaching the deferral cliff and want to sell before they become delinquent, or become delinquent after the deferral cliff and then are forced to sell, right? So you could have waves of selling that occur as we approach or as we pass the deferral cliff, but the magnitude of that wave at the moment is anyone's guess because it depends on how the economy is doing, depends on credit availability, it probably even depends on real estate prices, because if real estate prices hold up, it's possible that a lot of these homeowners, instead of defaulting, they go to private or unregulated credit, but they find some other way to stay current on their mortgage. So again, it's a $1 trillion question. We don't have an answer to it, but you know, I would be a little bit averse of trying to kind of gauge real estate prices before we pass the deferral cliff.
Yeah, talking about deferral, Griff, and to Brian's point on 90 days, are we, I think, going to expect a cliff around December? Because deferrals are till September and then they end, but then deferrals don't take the payments away. Eventually, you have to pay the lender. Like there's no way out. You can defer it. It's not reducing your interest rate. It's not interest-free loan. So it's only compounding your problem. It's just pushed out in time, and people are probably waiting for a miracle to happen, which may or may not. I mean, best case from people's perspective, the deferrals are extended till December, but 90 days from that, everybody's time is up. And like you said, everybody's time is up, going to be at the same time. Do you, like, even with the B lenders, is there enough credit? Like those rates are not good. I mean, they're really, really expensive loans. So if you're going to replace your 2.5% bank loan with a 5.5% private lender loan, it's not going to take you far. I mean, yes, I know you don't want to comment on the timing or the magnitude, but what about geographies? Are we going to see more in Toronto? Or GTA or outside? Like, where do we think? I mean, Vancouver was already crashing, so they're okay. Like they went through this already, so they're probably not going to get any worse. But for the Toronto region, which was in this amazing phase for forever, are we going to see a crash in the city, outside the city? Where do you think will be the most impact? And question to you both.
I'll let Brian start, I think, on this one.
Okay.
That's a good call, Nigel. I think, yes, we will see the cliff. And I think it's actually property type that's going to determine what type of cliff we're going to be on. So I actually pulled the listing data this morning and the sold data as it relates to condos and residential homes in the GTA. So just in terms of listings, as of this morning, when we compare the number of condo listings that have come on stream for the month of July, it's actually 56% higher than we saw last July. So in comparison to the month of June, the first 22 days were 6% higher. So what we're seeing a phenomenon in the GTA market is the condos, we're seeing a massive amount of listings hitting the marketplace. So if there's a lot of default on the condo side, you're actually going to see a lot of price pressure down. The opposite is actually happening on the residential side. You're seeing selling, there's a humongous demand now for coming out to the burbs and getting out of downtown. So you're seeing that exit happen. So I think actually on the residential product, even if you see it, there's so much demand right now that you're probably going to be okay. So if you're sitting into default and you're in a residential home, I think you're probably going to be okay. If you're sitting in a condo looking out at the CN Tower, you're probably going to be concerned at Christmas time when looking at it. So.
Yeah, so building on that, I think what we have right now is a bifurcated market. As you mentioned earlier, the COVID-19 has impacted renters and millennials, so people that are typically not homeowners and people that are typically renters. And the result of that has been rental price declines in Toronto. We're seeing month-over-month declines in rent prices, which is very, very atypical for the Toronto market. And the reason that's an issue is while homeowners haven't been impacted economically yet by COVID-19, lower rental prices means that investment properties are now earning lower cap rates, right? So cap rates are declining for condo investment properties, and that's negative for valuation. At some point, if these vacant rental units can't be filled or can't be filled at a rental market price that at least provides break-even or suitable cash flow to the investor, a lot of real estate investors that own properties, condo properties, in downtown Toronto or areas where we have concentration of rental units, they might have to consider selling. And on top of that, you have the Airbnb effect, right? We haven't talked about Airbnb, where a lot of these short-term rentals, due to the pandemic, can't get the occupancy rates that they were experiencing prior to COVID-19. So a lot of Airbnb rental investors are actually trying to convert these units to long-term rentals. So it's a bad time to try to take your Airbnb property and fill it with a tenant when we're in a pandemic where the people that typically rent don't have a job or don't have income anymore. So it's a really bad timing and confluence of events. And those Airbnb rental properties have had a downward pressure on rental prices, but they could also decide to try to sell instead of try to find a tenant because of how weak the rental market is. So the condo market looks to be under pressure, and the detached market, a lot of people that participate in the detached market are typically working in industries like finance, or maybe they're working in industries that aren't blue collar, more white collar, and they're not as impacted by the pandemic because they can likely work from home and they likely aren't restricted by public health policy at the moment. So you have people that either were waiting on the sidelines, that haven't been impacted economically by the pandemic, and they see this as a buying opportunity, so they're jumping in the detached section of the market. So near term, that's providing a lot of support at the high end of the market, but there's a lot of weakness at the near end, at the low end of the market, and that has to reconcile one way or the other. Either the spread between condos and detached are going to get wider over the coming months, and either we need condo prices to stabilize and start rebounding, or we need detached prices to go down, because at some point the spread between the price of a condo unit and the price of a house won't make any sense, right? The spread will be too large where the economics just don't make sense, where it's more attractive to buy a condo, or it's not as attractive to buy a detached unit. So it'll be interesting to see how this all shakes out, but I think we really have a tale of two real estate markets at the moment. But like Brian mentioned, over time, if new listings continue to increase, that's going to accelerate these trends, and we're going to see divergence grow over the coming months.
Got it. We have a bunch of questions from the audience on some of these topics. So talking about geographies, I'll launch a poll to see how people want to invest. But meanwhile, Nigel, Brian, I think we'd like to address some of the questions that people are raising as well. So I'm launching the poll and I'm letting people vote on it. Given that people are looking for suburbs much more. But the question from the audience is, actually there are quite a few if you read on the chat. One is, as we're talking about deferrals, it makes me wonder how will piling up on your expenses help the public to manage their expenses in the end? I think Nigel called it a cliff. Brian calls it a cliff. Everybody calls it a cliff. It doesn't help. But I don't know, Nigel, Brian, anything you want to add to it? Like, the short answer is does not. It's just hoping that things will magically switch back to normal and you will figure it out. But then that's not going away.
The real problem with mortgage deferral is now you've done away with your workout that you could have possibly done before. So you have nothing left to actually help cure that mortgage and bring it up to date, because you've reinvested the interest payments back onto that mortgage amount. So at some point the cliff does happen, whether we want it to or not. It's going to be there.
Yeah, the unfortunate part about the public policy of the cliff, which at the time made a lot of sense because you didn't want to be evicting people in the middle of a global pandemic. But the unfortunate part of it is that it's a fixed time period for everyone, right? If it was a staggered cliff, if it was a slope where you had the people that are on deferral slowly trickle into delinquency or find a way to cure or become current, that would make sense. But no matter how far you push it out, you're pushing it out at the same time period for everyone. So all you're doing is just moving the cliff a little further down, down your path, but you're still driving towards it. So unless there's if it was up to me, if I was a public policy kind of individual who could shape it, I would start converting the deferral cliff into vintages, right? So have the deferral cliff and break it out where a certain portion of that cliff winds down over the coming 12 months, instead of having it all kind of restart at one point in time. But that's a complex undertaking, and that's up to the regulators and policymakers to decide how to wind it down. But the solution is certainly not to just keep extending the cliff, because it's still the same impact. It's just at a different point in time.
Yeah, for sure. Thanks, Vedika, for that question. We actually have a slightly counter view on that one. So Venkat has a question. He says, why will end of deferrals result in panic selling? Because if the mortgage is insured, the risk is picked up by CMHC and other insurers. My sense is that there'll be some default, but not at the same level. What's your views?
In Canada, there's mortgage recourse, so it ends up back under the consumer at the end loss. So, you know, yes, the lender is protected, but I think the bigger conversation in the Canadian market is education around the consumer. So coming from mortgage default insurance, people, when they pay their CMHC or Genworth or Canada Guaranteed Premium, seem to think they're insulated to walk away from the property. They actually have judgments on default that goes against them. So the actual loss goes back to the consumer, even in a CMHC insured mortgage, which is a common misconception in the marketplace. So I've been doing lots of meetings with the banks and saying, and the insurers saying, we need to be educating the consumer to understand that point, because there is recourse in lending. And so yes, so it will go onto the market, it will get sold, and they face that loss.
Yeah, and that's an important point. I think you have to distinguish between risk for the insurer and the lender and risk for the person that owns the property. Like if you own a property, you essentially have equity in a leveraged asset. The lender, so the equity to you is an asset, but to the lender, it's a buffer that prevents them from taking losses on their asset, which is the loan that they're made on that property. So if you have a large amount of equity, that protects the mortgage insurer, that protects the lender, but it doesn't necessarily protect you.
Yeah.
If you don't have income and if you're not employed, how do you tap into that equity? I mean, who's going to lend you money unless you go to some, you know, payday lenders or some sort of really risk-loving, unregulated lender? Who's going to extend you credit if you're not employed, no matter how much equity you have? And how are you going to service your debt if you don't have income? So it's not a matter of choice. The people that are going to default aren't defaulting because they want to or they choose to. It's because they have no other option and they have to. And the problem, and that's okay if it's staggered over a long period of time. If we thought 10% of the mortgage market would default, but it defaults over 5 years, that's a lot more. And I'm using obviously a made up number here. It's not what I think, but that's a lot more manageable impact than if, you know, they all default or go delinquent at the same point in time. So what people need to think about is not so much just the number of people that will potentially default, but the timing of that. And the problem is that it might all occur within a very short window of 3 to 6 months, rather than over a year or 2 years. And that's how to think about it.
Right. I think what people don't realize is that when you're buying your house, yes, you're taking it from the bank and the bank is protected. Nobody's actually protecting you. You would still end up losing your house, and that's the problem. Like if you can't make the payments, and Brian's dealt a lot with distressed assets, but if I can't make the payments of my house, the bank will force me to sell. And if everybody is being forced to sell, I'll probably not sell at a good value, which means I will lose money. If the bank is insured, yes, CMHC will come protect the bank. But then as a consumer, there is no winning scenario for me in any of this. So I think that's something to keep in mind of, no matter what insurance or reinsurance exists, for the consumer or the end owner of the house, you will end up losing it if mortgage deferrals come to an end and there's no payment option. But talking about, sorry, go ahead, Brian.
I was just going to say, an important point is we've been working with the top national law collection law firm in Canada, and they're actually we're going to be launching joint videos around how to educate the consumer. If the consumer lets the collection lawyer at the end of the day have to sell their house, their losses triple. So if the consumers understand that they need to be proactive if they are going to lose their house, you know, they will have less loss and they'll have a better workout with the bank. As soon as the collection lawyers get in, take that loan loss number and triple it. So it's really important that the consumer has that much more education around what the loss, because that removes a lot more bankruptcies that come as a result of default. So I think the banks and even real estate brokers and mortgage brokers have to be really good about educating their client about being proactive around their default, and not using that ostrich approach of putting your head in the sand. It's going to cost you way too much money. So the only silver lining is that the rental prices are coming down. So you could exit maybe with a positive and get to a rental at a more cost-effective price.
Yeah. We have a bunch of first-time buyer questions that are coming our way. Obviously, now people who haven't bought a house are like, hey, if everything is going to crash, maybe it's a good time for me, in simple terms. And I would hope everything is crashes so that I can buy cheap. That's what every buyer hopes for. So the first one is from Gurpreet. Thank you, Gurpreet. He's asking, for the first time home buyers, does it make sense to wait till winters or buy maybe a little further west of GTA, detached or semi? Okay, three-part question, I guess. His hypothesis is work from home being a reality, demand for outside GTA might increase, especially for detached. So first question, should they wait till winter is the question. I would think yes, because there's so much uncertainty in the like best case scenario or worst case scenario. At least some of this will go away. You would know if there's a vaccine on horizon. You would know what happens to US. You would know whether we are able to open up and what happens to CERB. So at least some of the unknowns would be known, and at least you'll be able to make a better informed decision than you would now, because right now it's everybody's guess, and you will have a little more clarity in a few months' time. Nigel, Brian, what do you guys think? Wait till winter or not?
Look, as a real estate broker, I would get asked this question every single day, and you always get asked, is it a good time to buy? And the right way to answer the question is, it's a three-pronged approach. So the right way to look at it is intention. So if I need to buy a house because I'm having twins and I live in a condo, it doesn't really matter what my timeline is, it's now, or the state of the market. So your intention is do I need it and I have to go? If it's a timeline issue, it doesn't really matter. We built a data company because it's state of the market. So if you can be patient on your intention and patient on your timeline, then you look at the housing stats that are going to tell you, is it a buyer's market, is it a balanced market, or is it a seller's market? And if you look at your home as an investment, the right way is to always try and buy a house within a buyer's market or a balanced market. You know, we have seen that the Canadian housing market has been 95% in a balanced market. So you only have 2.5% on either side to try and time it and have that good buy side. So most first-time buyers end up edging out of the marketplace because they wait too long. Average prices are increasing. So look at number one as your timeline. If you're living in this house for 5 to 10 years, it doesn't really matter at that point and around. Secondly is, do I look at outside of the GTA? And the answer is yes. Look at that $400,000 to $500,000 price point within commuter shed of the GTA. Is the hottest demand market. We're doing research on St. Catharines. We're doing research. No one ever would have thought that Kitchener, Guelph, Cambridge would have ever exploded to the levels that it has. So absolutely, anything in that $500,000 price point, if you can find it and you can drive to the GTA, it's going to be a good investment.
Yeah, so I agree. There's a lot of uncertainty out there. I mean, we don't know what's going to happen with work from home. We don't know if that's permanent or temporary. We don't know when the vaccine or the coronavirus will go away, so when economic activity is going to go back to normal. And we don't really know right now how long interest rates are going to stay low. If the quicker the economy rebounds, the quicker the coronavirus goes in the rear view, the more likely it is for rates to move higher. So there's a lot of factors we don't know. But ultimately, I think what matters is, you know, the only question you really should ask yourself is, can I make my monthly payments? Like, that's what really matters. And if you can't, or if it's challenging to in the current environment, then you probably don't want to. There's too much economic risk out there. If you can, and you intend to live there for 10, 20 years, then even if prices do decline, as long as you have a bullish long-term outlook for real estate and you can keep making your payments, you should still, you know, view buying properties as favorable. But, you know, if you are a first-time home buyer, timing is important, and I don't see why you would have to buy now. I don't see what the urgency is at this very moment where you have to jump into the market, because I don't think, I mean, prices have gone up recently, but, you know, we've talked about that being driven more by the detached space and the condo space. So if you are a first-time home buyer, there might be more attractive entry points for the condo market as the rental market shakes out and as people decide where they want to live, whether it's in the city or outside the city. So you're probably going to get paid to wait here. Just sit on the sidelines a bit longer, wait, get a better sense of what's going to happen. And, you know, I would suggest waiting for the deferral cliff to wind down, because that is the major risk factor out there. And if you can wait 3 to 6 months, and wait for the deferral cliff to kind of pass. Even if you end up paying, you know, maybe 10, 20, 30,000 more, 50,000 more for the property, it's worth it because you eliminated a very substantial risk that you would have faced if you bought today. So, you know, given everything we know at the moment, I think waiting is the right move at this moment in time.
Fair. So that was on the timing. The second question is more around the type of house. And we have somebody asking that detached and semi-detached seems to be stable. And earlier we talked about how condos and the rental market in condos is seeing this rush of new supply from Airbnb short-term rental kind of setups, which means condos are expected to go down. Talking about the different kind of house types, what is you guys think the recommended approach? So should you go for, if you're going for a semis or detached, go ahead, buy, no point waiting. But if you're going for a condo, then it is different. And a related question to that one is, where can we find indices to see the spread between condos, detached homes, and other home types? Brian?
Sure. If I was buying, so I'm an active real estate investor as well. So when I look at the condo market right now, I'm pretty much sitting on my hands waiting and looking. When I'm looking at the detached and the freehold category, I'm almost about to sit on my hands because I'm watching the market move from a balanced market into a seller's market. And I bet you by the end of the month, we'll be in a seller's market. So as soon as we get into a seller's market, history has shown us that we lose money potentially as a real estate investor. So what's keeping me up is I'm watching rental prices go down. If you're in a seller's market on the residential side, you could be overpaying, and it could be a perfect storm for you around it. So I've started to do a lot of due diligence around new construction and projects again. So, you know, downtown Toronto has been future priced for the last 7 years, but this is actually going to create an opportunity around new construction to say, do I buy it? And a lot of what we do with our clients is we actually look at, make sure they're not overpaying for new construction because it's ready in 3 years. So historically, we've seen that you paid a future price when you bought that condo. Now is an actually a really good time for a real estate investor to start looking at new construction in GTA as well as outside of the GTA, because it'll be ready in 3 to 5 years time, depending on whether it's a condo or whether it's a residential house. So I think I'm currently doing more due diligence on new construction than I am on the resale, because to Nigel's point, I want to see where that cliff ends up as an investor before I really start to be actively buying again.
Yeah, in the pre-construction market, we haven't talked about it, but it's an interesting point because prior to COVID, you know, a lot of the pre-construction pricing, I think it was some units were up to $1,300 a square foot. A lot of that pricing, the underpinning assumption was for rental prices to continue to go up in Toronto. I think I saw some research where the expectation was rental prices to go up by 50 to 60% in the core downtown market. And that was a justification for paying a premium for pre-construction. So that's going to be interesting because now not only do we have prices not going up for rents, we have them declining. So how does that impact the demand for pre-construction? How does that impact the pricing for pre-construction? I don't know. That's another kind of variable that's hard to pin down and to really determine what the impact would be. So, you know, like I mentioned earlier, we do have a bifurcated market. You know, there's more supply, I think, as Brian mentioned, coming online for condos, and that makes sense given declining rents, Airbnb, and probably a higher mix of investors in that market. So when you think about sellers, you have to think about who has to sell, right? You either have someone that lives in their house or someone that owns an investment property. If it's an investment property, you're much more likely to sell because you still have a place to live. If you're living in your house, you're probably much more reluctant to list it and sell and move. So any portion of the market that has a higher mix, either by property type or based on region, a higher mix of investors are more likely to see supply shocks. So in downtown Toronto, that's probably condos. And then I think there's more speculation up north in North Toronto in the York region. I haven't followed that well. Brian probably knows more than I do. But you know, if you're thinking about this as regionally or as an investor or a buyer, you want to pay attention to the areas of the market or the pockets that have a high mix of existing real estate investors, because those are the people that are most likely to liquidate and sell if they're worried about, the economy or there's negative sentiment about real estate prices.
True. There's also a question on, are there indices that people can use to compare the different pricing spreads between detached condos and other property types? I mean, I've only ever used the government websites for that to get a sense of the average price. But I think at an individual level, like we at Buy Properly try and do an estimate. I know Brian and his company try and do estimates of what the true value of an asset is or a neighborhood is. But what else would you recommend people look at?
We built a beta index to try and answer the simple question of, should I buy a freehold or should I buy a condo? And then, so it was actually pre-COVID in our beta, and we figured out that condos were the better investment in doing it. And then it was, should we actually buy a bachelor or a 3-bedroom? Because, so we started to look at the cash flows, the average rents, and the average purchase price in order to come up with an index to kind of point us around what we should be buying. What it told us prior to COVID was we should have been buying bachelor units in Mississauga. And it really came down to a price point of $380,000 on an average rent of $1,700 versus downtown Toronto was $550,000 for $2,200. So, there's clues around the two, and it's looking at more data. We'll be ready with our index probably by the end of the year. We've had to do lots of recalibration because of COVID and prices going down and testing, but keep an eye on average rents, what's taking place there. Keep an eye on, what our average price is doing. And the one tip we tell all of our clients is, it's the most boring ratio, but it's really looking at a housing market classification. So it's really looking at sales to listings ratios and seeing what they're selling for. And if you're in a buyer's market, then you're going to be okay. As we move into the sellers, I think everyone wants to be a buyer's market. Give me a deal on a property. And real estate investing is not a single point in time like an equity. You have to have a longer term view on it. So if you're trying to get in and get out, you most likely will get hurt. If you're looking longer term and you're patient, I think you'll be fine.
Yeah, so just touching on the point of indexes, I know TREP does provide, I believe, average prices for condos, detached, semi-detached. So you can look at the average prices there. Korea does have a home price index, so does TerraNet, but I'm not sure they break that out by property type. But with that being said, like those type of indices are more relevant for people like myself who are doing more macro analysis and kind of high level analysis. I mean, it's not really going to help you that much if you're an individual real estate investor or a first-time home buyer, because real estate's a very localized market, right? It varies a lot based on region and property type and neighborhood. So looking at an index as a way for you to gauge whether or not you should be buying a property in, I don't know, Mississauga or Cabbagetown or Richmond Hill is not going to help you that much as an investor or buyer. What you should really be paying attention to is what are the overall trends, and the trends for the condo market aren't very bullish. The detached market's doing better. And what are the risk factors out there? And as we've discussed, there's a lot of uncertainty where if you don't have to jump into the market, you don't, because you have a choice right now whether or not you want to take on that risk. And there's no need to take on that risk. And if you already own real estate, then you can evaluate and determine whether or not you want to reduce risk. And that's how you should think about it. I wouldn't pin your decision on how indices do, because that takes a very fragmented, localized market and aggregates it at a higher level, which probably isn't as useful for the individual buyer.
Right. That's a fair call, and we can share with the audience some of these indices links so that you have an easy reference after, as long as you've registered with us, you will share some of the assets that exist already for quick reference. But like Nigel said, they are great for macroeconomic trends. They will give you a sense of how vacancies are doing. Vacancies are going high. Clearly, you want to stay out of that neighborhood. And if the vacancies are going low, you know that relatively you are better off. But then you have to layer in the individual property. Like when we are evaluating at Buy Properly on whether or not to bring a deal to the platform, we not only look at some of these macro trends, like for example, what's the average vacancy compared to a 10-year vacancy rate there, or median 10-year vacancy rate, to see where is it trending and where it is on the real estate life cycle. But we are also looking at things like neighborhood, transit, because all of them add up And I think it would be unfair to use just an overall indicator. You have to use the macro and the micro together before you buy one unit. But talking about supply, there was a question saying, what do you think is the impact of immigration on house prices? Because we've talked a lot about Airbnb changing the whole equation, deferrals changing the equation, but then there's a key piece in at least the Toronto market, which is the net inflow of people. Like, I think 2 years ago, that number was like 90,000, 60,000. There's always been in that range of net new people that come into GTA, which has been driving the prices all of these years. Now that's on a pause. And if the economy were like it is, even if you were to open up the immigration, and I was sitting somewhere outside of Canada, with Canada going through this current turmoil, I wouldn't risk leaving my job and moving to Canada for no matter what it was. So we haven't factored that in at all. But then that's another factor that I think should make it go down further, because the demand's going to go down. Do you guys want to address that, the immigration impact?
Sure. Okay, I can start first on this one. I mean, when we looked at immigration trends, and there's a metric called non-permanent residents. So when you look at that, which are people that are here on visas but they aren't a PR yet in Canada, so typically students and people that are newly immigrated. So when you look at that historically, it's very cyclical. So what does that mean? Well, it means, yes, immigration is a positive for real estate when the economy is growing and when the economy is doing well. It is a variable that compounds the benefits of real estate growth and price appreciation. But it's also a cyclical variable, which means that it doesn't provide support when there's an economic contraction. When there's an economic contraction, immigration drops, the number of new immigrants drop. You might actually get emigration. Might get people leaving the area on a net basis. So it's highly cyclical. And right now we have policies in place that actually prevent immigration for students or for people that want to come to Canada. But even if those are listed, because of the economic conditions, it's unlikely that immigrants are going to come to Canada at a high level and a high rate, because it's not as attractive anymore. It's more challenging for everyone, not just immigrants, in the current economic environment. So you don't expect immigration to be the force that stabilizes the real estate market. Ultimately, what will stabilize the real estate market is affordability, unemployment, and a little bit of sentiment, right? Because that might control the number of people that want to sell their property, especially if they have investment properties. So that's what will determine what happens with real estate. Immigration is more of a variable that compounds all those effects, either negatively or positively. So I wouldn't really view immigration as linchpin.
Yeah, that's rightly put. But like, my worry is that with immigration going negative, is it going to compound and make it even more negative in the current environment? Because things are already looking negative, like you rightly said. Does the compounding effect mean that we will see more price falls and like even worse in terms of demand supply mismatch on condos, because a lot of new people would probably rent condos to start with until they figure out stuff? That's my big concern with the whole immigration piece.
Immigration drives your current rental market, and the bad news is that's not performing as we want to see positively. So that reduction of people coming into there, and then that has an impact 3 years for when they buy their first house as well. So there is multiplier effects by not having a positive net migration to the GTA. So
okay, we talked about different kinds of houses. So on that note, I have a question for the audience on, if they were to put their money towards the next 3 years, towards something in the next 3 years, what would you choose? Oh, I see people are choosing pre-construction. Maybe not.
You know, and I guess while we're waiting for the answer for that question, I'll touch on something that we didn't have a chance to talk about, which was cash flow of investors. So, we have a housing conference, and as part of our last housing conference, we ran a survey where we wanted to gauge, what is the mix of the cash flow status of different investors in the real estate market. What we found was about half of the investors are positive cash flow, about a third are negative cash flow, and about 20% are break even. And this was in October of 2019, right? So the issue here is that when you have rental prices going down, that 50% of the existing investors that are not positive cash flow, there's more pressure being placed on them. Either they're break even and now they have to tip into the negative, or they're negative and they might go more negative, right? So the challenge with that is, even if you are positive on real estate, you probably can't sustain a negative cash flow environment asset, and you probably don't want to sustain a negative cash flow asset in this environment. So it's something to keep in mind as well.
Cool. I think we are out of time. We have a bunch of open questions still remaining. There's just one last one that I will take because it's an interesting one. It says, when you say take a long-term view of real estate, what is long-term from real estate perspective? Is it 3 years, 5 years, 10 years? What is that magic number that makes you think it's long-term?
My personal number when I look at the investment opportunity is always 5 years. Am I going to be happy with this investment 5 years from now? And then and what I've found buying new construction is that I'm always thrilled after that 5-year mark. You've paid down a lot of principal residents, and talking to your point, Nigel, I'm a little bit different. I'll go counter your opinion. I've actually bought real estate investment properties with negative cash flows. And my magic number was $300. So when I buy investment properties, I knew what I wanted the future price to be. I knew where rents would go. And then I viewed I was actually going to give money to an RSP. So I was subsidizing my real estate. And every one that I've ever done sort of has worked out well, because they're on the periphery of the GTA and they're in the affordable price point. So it just requires a little change around. If you're purely cash flow driven, you'll never buy anything in the GTA. That's been the hard part. Or you're putting such a massive down payment, that may not be a good use of funds. So for me, 5 years. After 5, then I relook at it because my mortgage is up. Do I buy? Do I sell? What do I do with the asset? And I usually, by that point in 5 years, rents have gone up tremendously, and I have a cash flowing property usually by that 5-year mark.
Yeah, so the way I think about it, I'm a financial services equity analyst, so I like putting it in the context versus equities. And a lot of times people will put up a chart of the TSX and they'll look at it best relative to real estate prices. And when you look at it on that metric, it looks like the TSX outperforms real estate, but you're not factoring in leverage. Like, the main reason why real estate returns exceed stock market returns is because when you buy real estate property, there's inherent leverage in it, at least 5 to 1 if you put 20% down. And if you put less down, then you have more leverage. And that's what you have to keep in mind, that you're taking a levered return on equity investment when you buy real estate, and it's less liquid. So how does that perform? That performs well in time, as long as you can manage the debt associated with that property and you don't have to liquidate it. And we've talked about these regulatory measures that are restricting real estate, but you have to think about the context historically. Like, a real restriction on real estate was when the Bank of Canada rate was 18%, right? That was in the late 1990s. That's an actual restriction on the ability to purchase real estate. Right now, we have very marginal restrictions at the periphery and at the margins of the market. So ultimately, it's not the regulatory body, the Bank of Canada, or any other regulation that's going to cause a restriction on real estate, the ability to buy real estate. It'll really depend on the economic conditions and the strength of the Canadian household and the ability to manage debt. And how that happens and how that plays out, we'll find out over the next 6 to 12 months. So it'll be an interesting period of time, to say the least.
Yeah, I think my magic number, to Brian's 5, is probably more like 7 to 8 years, because I think that coincides with sort of the equity market cycle. And every time the equity market wobbles, the real estate also has some jitters, some shivers, and so you have to at least if you started with a jittery equity market when you bought it, then you have to at least wait till the next one to actually encash the whole thing. Because even though those two are not correlated, they do have some compounding effects, to use Nigel's term, on each other to some extent.
Yeah, and one last point, if I may, just real quick. The equity markets does have an influence on how people view real estate assets. Right? There's stories of how buyers are still looking for relatively elevated prices, and part of that is being influenced by a lot of multiple expansion you're seeing and a lot of high valuations you're seeing for public equities. So equities may not have a direct link to the market, but it does play a lot in sentiment. The last time we had a lot of people try to sell real estate in Toronto was when we had a flash crash in equities in December of 2018. You saw a lot of detached units kind of hit the market. So it could have a wealth effect for people that own properties where, because you feel richer, because your equities are doing well, you're less likely to sell your real estate property. But if equities do poorly, all of a sudden your sentiment changes, and now you're more willing to sell your real estate asset because you're worried about your net wealth. So it plays a role more in just the psychology of the investor rather than the actual financial status necessarily of the asset or the attractiveness of the investment.
Thank you. And we are kind of out of time. It's 12:06. Thank you, Nigel and Brian, for this really, really informative discussion. I like that both of you are driven more by data and analyses than just what you think is the right thing or what you think the winds are blowing towards. Appreciate the audience asking a lot of questions. Unfortunately, we couldn't address all of them, but feel free to write to us, and we will try and take those questions to Brian and Nigel and share with you offline. So thank you everyone for joining, and hope you have a great day.
Thank you so much.
Thank you.
Thank you.